Time and time again, I've talked about how great dividend investing strategy is, especially here in the Philippines. Dividend investing gives you the sense of feeling secure even when markets are down or stagnant for a long time, because it gives consistent cash flow no matter the state of the market. If you look at the ETF that tracks a PSE index, FMETF, it has been trading sideways for a long time. But even though it's like that, my dividend portfolio is up 15.16% compared to the market, which is down negative 12.14%. Now, even though my portfolio is up, if we only look at capital gains, I'm only up a measly 2%. So almost all my gains came from dividends and the dividends I've reinvested, which earned more money for me every year. Now, although my dividend portfolio is beating the index by a lot, I don't know if this is a good enough comparison to say dividend investing is superior, as I only have 5 years of data. But there is also a comparison of the dividend yield index versus the main index for the past 11 years, and surprisingly, the dividend index reigns superior. That's why I love dividend investing. While I'm waiting for stocks to go up, I am consistently earning money, especially here in our country, which tends to move sideways for a long time. That's why the dividend index has beaten the main index for a couple of years now. As our market has traded sideways for a long time, almost all returns came from dividends for the past 10 years. So even if the market continues to do so for the next years, my portfolio would still continue to grow faster as I reinvest dividends. And the best thing about it, the more stocks go down, the higher dividends I get. It's still a win-win situation even when the market is stagnant or down. But the big question here is, how do you build a good dividend portfolio? A portfolio that can still grow your money while markets are down or stagnant and will continue to do so over the years. Where do you start? Well, that's easy enough. Just remember these basic tips. First of all, for me the biggest one to note is, stop chasing after yield. This is the biggest mistake a lot of dividend investors make. They just invest randomly in companies that have a very high dividend yield. The worst part of it is when companies announce they will pay a good chunk of dividends, they go running just to grab a hold of that payout. Well, you may get lucky sometimes if you do this, but chances are your portfolio wouldn't sustain that amount, or worse, you even lose money as stock prices usually go down after the ex-dividend date. If you're not fast enough to sell, then you'll be down big. Before you grab that high-yielding stock, do your research first. Where does its big yield come from? You have to check first the history of the company. Have their earnings grown over the years? Because if the company pays out a huge chunk of dividends year after year and their earnings aren't growing, well, I don't think they will be able to sustain that. Check as well if the company handles its debts well. Large debts can be a hindrance to a company's growth in the future and may lead to it decreasing its dividends. Remember, it is better to hold a company that pays a fair amount of dividends, but their earnings, equity, and debts are managed very well, because there is a high chance that their dividends are sustainable, so a consistent payout every year, and eventually, it will increase as their earnings increases. So check earnings, equity, debts, and their payout ratio. Too high of a payout ratio may not be sustainable. If the company is paying 100% of its earnings to its shareholders, then for me, that's a red flag. Just imagine, if they pay all they earn, how would the company grow if there's nothing left to reinvest back into the company? As a dividend investor, you want sustained growth in your dividends, and by investing in companies that have good financials, the higher the chance this will happen, and eventually would even lead to higher capital gains as well. And lastly, you need to buy it at a reasonable price. As I said, can lead to higher capital gains. As a dividend investor, you also want to concentrate on getting good bargains, and not only does this benefit you in higher capital gains, but also in higher dividends, as buying companies at a cheaper price gives you a higher yield. To summarize this, great company that pays consistent dividends bought at a reasonable price. Now before we dive into the next one, if you want to analyze companies and don't know where to get the data, then there's a simple solution for you, which is simply Wall Street. I've been using this platform for years, and it has made my investing journey easier. They have graphs, analysis, comparisons, and the way they present their data is so easy to understand. They have a bunch of tools here for you, like a portfolio tracker, a screener to easily filter out stocks faster, and a watch list so that you can be notified whenever the company releases its earnings, dividends, when insiders are buying or selling, and when the stock falls below its intrinsic value. So if you want to try it out, they offer their basic plan forever free, and if you want to avail their paid plan to get unlimited access to all the tools, use my link below and get up to 40% discount. Thank you, and back to the video. The next one is a highly debated topic, diversification, or should I say proper diversification. Many ask me how many stocks should I put in my portfolio. Well, listen up. For me to answer this question, you shouldn't limit yourself to a number of stocks like 5, 8, or 10 stocks. Don't set those kinds of rules for yourself. For me, it's the number of stocks you can keep track of, and of course the number of stocks that passed your checklist a while ago. And there are also points you have to take note of. Proper diversification should be spread in different industries, especially if you are a dividend investor. For me, I want consistent dividends no matter what the state of the market is. So if I'm properly diversified on different strong companies, which I bought at a reasonable price, and I'm diversified across different industries, if one of my companies had a bad year, which normally happens, most companies have sudden growth in some years, then a little stagnation in the next year, then the other companies in my portfolio can compensate for it, making my dividends unaffected by that one industry. Let's say for example during the COVID years, some of the stocks in my portfolio decreased their dividends, like the real estate sector, but since I'm diversified across industries, the ones that weren't much affected by the pandemic maintained their payout and some even increased it. So I don't like putting exact numbers as to how many should I have in my portfolio, but what I look at is the companies that pass my checklist and the number of stocks I feel comfortable holding and can easily track. For me, I'm not a fan of a concentrated portfolio, especially for a dividend investor. If you aren't Warren Buffett, who can analyze so much of the company, he has all the resources and tools, and even with all that, he still makes mistakes with his level, then I better be off holding a bunch of companies that I have analyzed myself and have deemed to be strong companies that I know will pay me consistent dividends. And if that company does have a bad year, I know they would get through it because of their strong balance sheet. So having a strong group of companies working for me gives me a sense of security, which helps in maintaining a good mental state. I didn't panic when my portfolio plunged during the pandemic, as the companies I hold I know are strong. I don't panic if one of the stock prices of the companies I hold plunges, as the other companies that are doing well mitigated the effect of it. In fact, I have companies in my portfolio that are down big, but overall, I'm still in the positive. And since it's like that, I can even add more to that stock comfortably. I will add more to it up to a percentage of my portfolio I'm comfortable putting in it. That's how I know I will stop adding more money to a certain stock if its percentage in my overall portfolio gets too big, and I'm no longer comfortable putting more. I stop and invest in other stocks in my portfolio or watch lists that are still undervalued. I just leave it there. It's a strong company anyway and will give me consistent dividends. So that's how I approach diversification. I diversify across strong companies, across different industries, and I put in an amount that I am comfortable with. I play the long game, so I don't want to be worried every day because I put in too much of my money in just one stock. And with a group of strong diversified companies at hand, the more consistent my dividends come in. I get dividends at different months, and I instantly reinvest it back, allowing me to take advantage of that snowball effect immediately. And lastly, simply be consistent. Consistent in investing every month, consistent in reinvesting dividends, and consistent in gathering more knowledge about investing or studying more companies to have a chance to find good bargains. Dividend investing is a long game. The dividend snowball effect takes years to gather enough momentum to really grow larger and larger and eventually surpass the money you can invest every month. For example, if you invest $240,000 a year or $20,000 a month, at year 14, the dividends you get will be equal to your contribution. This is only with a 5% yield, and it will only take you 6 years to double that to $480,000, so less than half the time it took to reach the value of your contribution. This is because of the snowball effect of compounding dividends. Starting year 10, it takes you less than 3 years to get to another million, and after year 15, it takes you less than 2 years to add $1 million to your portfolio. This is all from dividends. So I know it's tempting to cash out your dividends, but take a second and think about it first. Just imagine if you reinvest it, it will earn more money for you. Let it grow first to a considerable amount. Like in my portfolio, right now I earn $128,000 a year or $10,675 a month from dividends. If I reinvest this amount and I get the same yield of 6%, which is the yield of my portfolio, this will earn me 7,680 pesos the next year or an additional 640 pesos a month. That's how I like to think about it. So remember, dividend investing is a long game. You have to be consistent enough to let your portfolio grow first. You have to be consistent enough to stick with your strategy. So with that said, I hope you've learned something from this video, and if you did and still haven't clicked the like button, I'd appreciate it if you do so before leaving. Thank you, and see you in the next video.